Well, welcome to 2025 trading. We're half an hour away from the opens in Hong Kong, Shenzhen, Shanghai. You're watching the China show. I'm Annabelle Droulers in Sydney with Avril Hong in Singapore.
Our top stories: the US investigating whether a Tesla Cybertruck explosion outside the Trump Hotel in Las Vegas may be linked to a suspected terrorist attack in New Orleans, where a truck plowed into a crowd, killing at least 15 people. Also ahead, Asian stocks facing a negative start to the trading year, although Hong Kong may be a bright spot. We'll get China's Caixin PMI numbers this hour. And Alibaba will be in focus after a further retreat from physical commerce, while BYD sets a new monthly sales record as it vies with Tesla for top global EV sales in 2024.
Well, as we said, welcome to 2025 trading. And as we kick off another year, it does seem like every single road for investors leads all the way back to Donald Trump. What does he mean for inflation? What does he mean for tariffs? What does he mean for Fed policy? Off the back of that, it's just a high level of uncertainty for a lot of investors. So today you've got Asian equities, ex-Japan, Japan still shut for another couple of days, but coming online fairly cautious so far. You're just seeing a special ceremony taking place at the Korea Bourse to mark the start of a new trading year. We'll get more details on that just a moment, but the Kospi is there just a little bit in the green. Shares in Sydney, a little changed a couple of hours in. Japanese markets, as I said, they're shut through January 6th, but we are continuing to track what's happening with the Japanese yen over there. 157.48 right now. Priming, of course, the currency. We've got looking at perhaps, a third straight drop against the dollar, but it has really been that strong run for the greenback, the hallmark of 2024. In fact, the Bloomberg dollar spot index having its best year in nearly a decade. Also tracking oil there, as we said, fairly steady. Korea, just to notice, we said it's just coming online. We do have this special ceremony underway, but to note as well, we actually heard from the Bank of Korea governor earlier, vowing to closely monitor what are a confluence of different risk factors. Of course, we've got the ongoing political turmoil. We'll be talking about that later in the show today, but also the impact that is happening on the stock market, on the Korean won, and really how that could also having a major impact on monetary policy. The Bank of Korea governor also saying it's really hard to stabilize the economy with monetary policy alone when you do have this sort of current situation underway. So we'll leave that there. But let's also take a look at what could be one of the biggest gainers for 2025. And actually, that is Korea. We've been crunching the numbers for major EM, DM indexes, and Korea is seen as perhaps having some of the best upside potential. This chart here taking a look at implied upside for equity benchmarks based on analysts' bottom-up 12-month range. So you're seeing there big gains for the Kospi, perhaps also big gains maybe for China, Avril. And you're seeing the CSI 300, the Hang Seng there, perhaps we could see 25% move higher from where we are today. Of course, a lot of what happens with China really depends on the health of the local economy, the sort of stabilization efforts that are seen. Let's take a look at how futures are setting up for 2025 trading today. And we do actually just see them here looking a little bit stronger. We had really positive news, for instance, to end 2024 with government worker salaries being lifted. But as well today, you're going to have a bit more of a reading, a bit more of an update on the healthy economy with that private PMI survey due in about 40 minutes from now.
Yeah, we'll get those China Caixin manufacturing PMIs that focus more on the smaller export-oriented firms, where we see an element of front-loading. In terms of data, we're also watching out for Hong Kong retail sales. And of course, today is the first trading day of the year for Chinese stocks, and it was an annual gain, the first since 2020. So keep that in mind as we look at how stocks fare today. Keeping an eye on the yuan fix as well. We did see it breach 736 briefly on Tuesday, and this was blamed on thin trading conditions. That's on the offshore yuan. We had the Chinese government bonds, the yield on the 10-year hitting record lows as well earlier in the week, and this is following on from the PBOC stepping up liquidity operations, kind of underscoring their accommodative stance. So a couple of things that we're watching in the Greater China region today, Belle.
Yeah, and Avril, moving to our top story now. Well, the FBI says it's investigating a terrorist attack and hunting possible accomplices after a truck was deliberately driven into a crowd in New Orleans, killing at least 15 people. And President Biden says police are looking into any possible link between that attack and the explosion of a Tesla Cybertruck in Las Vegas.
We're tracking the explosion of a Cybertruck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection with the attack in New Orleans. Thus far, there's nothing to report on that score at this time.
For more, let's bring in our U.S. managing editor, Miles Miller. And Miles, this seems to have been an act of terrorism, perhaps, but what do we know about the investigation so far, and what's the current focus of it?
Yeah, the current focus of the investigation is to figure out if this suspect in this incident, a 42-year-old man from Texas, was self-radicalized. Like, how did he determine to pick Bourbon Street in New Orleans on New Year's Day to ram into a crowd of 15 people, killing 15 people and injuring 35 others? Right now, law enforcement are trying to figure out how this happened, and they're also trying to figure out if there was any material support that aided in this attack. Now, this happened 3:15 in the morning. The suspect, identified by police as Shamsuddin Jabbar, a 42-year-old U.S. citizen from Texas, who the FBI tells us is a U.S. Army veteran. We're told that when he rammed into that crowd of people, police immediately engaged him, and when they did, they found an ISIS flag on his vehicle, and in addition to that, they found improvised explosive devices on the vehicle as well. They also found a number of improvised explosive devices in parts of the city that were actually very near to where this ramming attack happened. Now, the FBI said that they, at this point, are trying to determine if he had any help or if he worked alone. An initial report of seeing people near where those improvised explosive devices were found has now been determined that those people are not related to this. But again, this is going to be investigation focused on why a vehicle ramming attack. Was he inspired by ISIS? They're going through his home in Texas to figure that out. In addition to this ramming attack, he stayed at an Airbnb in New Orleans, and that Airbnb caught fire this morning. That fire was put out, so they'll be going through that as well to try to determine why he launched this attack here.
They're also investigating the Cybertruck incident, whether there were any links to what happened in New Orleans. What do we know about that? Because Musk is saying that it could be an act of terror. It could be linked to New Orleans.
That's right. So just before 9 this morning in Las Vegas, a Cybertruck pulls into the driveway of the Trump Las Vegas hotel. That driver in the car was killed. What happened was that car caught fire and exploded. What we know about that incident is that smoke basically was pouring out of the vehicle, caused a large explosion. The driver of that vehicle was killed. 7 others had minor injuries. And the reason why there is an investigation into a link is because both of the vehicles, the Ford in New Orleans, the Cybertruck in Las Vegas, both were rented on the app Turo, which is an app where private car owners can lend their cars out for a fee to people who want to drive their car, say they have a car that they like. And in both of those incidents, this car rental service was used. They'll determine if there was a link, but right now it's being investigated by local officials and the FBI as a potential act of terror. They'll try to determine who was behind that one. But in this instance, as you said, Elon Musk said that they have confirmed that this was an explosion caused by large fireworks and/or a bomb carried in the bed of the rented Cybertruck.
Miles, thanks so much for bringing us the latest. U.S. Managing Editor for Bloomberg TV, Miles Miller. Now on to what we're seeing or expecting out of China's economy. Data is due later today on the Caixin manufacturing PMIs. We're actually going to be getting it in about 35 minutes from now. We're bringing in our China correspondent, Min Min Lo. So Min, when we look at the Caixin manufacturing numbers, what's expected? Because they are, after all, a survey of the smaller, more export-oriented firms. Are we going to see stabilization, or is that going to be an element of front-loading there?
That's right. We are going to see this continued divergence between the private Caixin survey versus the official data that was out on Tuesday. Economists forecasting a 51.7 print for the Caixin manufacturing PMI. Again, as you said, because of exporters front-loading shipments to the U.S. ahead of Trump's inauguration to mitigate any tariff risk. But this contrasts with the 50.1 print we got on the official data on Tuesday, which showed some softness. The official data, of course, captures more of the state-owned enterprises. And if you look at the non-manufacturing PMI from Caixin that is due out next Monday, is expected to come in 51.4. We did get a big beat on the official services PMI, though 52.2 was what we got on Tuesday. And this is on the back of the rebound in construction because we just got those home sales data out today, preliminary data showing that December home sales remained unchanged from a year earlier, which is a good sign of stabilization. And in fact, sales increased by 24% compared to the previous month.
So, Min, we spoke earlier this week about President Xi's New Year address, and what were some of the highlights from that?
Yeah, so he said in a New Year event that China is expected to, or China has already hit that 5% growth target. And in a separate New Year's Eve speech that is televised across the country, he also projected confidence in China's economy and talked about some of the breakthroughs China has made, for example, in its space mission, in its AI, quantum computing technologies. And of course, we know these are all areas where China is locked in a tech race with the United States. And on the geopolitical front, again, he emphasized the importance of the one country, two systems model for both Hong Kong and Macau, and talked about the inevitable reunification of the motherland with Taiwan. And this comes as President Lai Ching-te of Taiwan made his own New Year's Eve speech to the Taiwanese people, vowing to step up or to continue increasing defense spending and displaying Taiwan's resolve to fight. And of course, against this backdrop, you have the uncertainty around Trump's Taiwan policy, given that Trump has repeatedly said that Taiwan needs to pay for its defense. And when it comes to the economy, President Xi acknowledged some of the challenges that China is facing and vowed to continue economic support in 2025, calling for more proactive macroeconomic policies to tackle external uncertainties.
That was our China correspondent, Min Lo, and we're counting down, of course, to the open of trade in Shanghai, Shenzhen, Hong Kong. You're watching The China Show as we count down, of course, as well to the private PMI readings that are due in about 30 minutes from now. But futures are looking like a little bit of upside potential as we kick off 2025 trading. This is Bloomberg. You're watching The China Show, taking a look at futures here. We're about 15 minutes from the open of trade this morning, and we're actually looking like a little bit of upside potentially. So against the backdrop of what is quite a lot of caution for other Asian equities, although Japan, of course, is shut as well. Watching for the yuan fix, we should get that any moment here today. But let's bring in our guest, Ding Xuan, Chief Greater China and North Asia Economist at Standard Chartered Bank. And thanks very much for joining us. As we said, first day of trading in Hong Kong for 2025. But the outlook for you, it does seem like for a lot of investors and economists as well, that there is just a high level of uncertainty. So what are you watching most closely? Is it the external factors, for instance, with Trump, or is it more the internal ones, including with how China deals with the property issues, also consumption?
First, Happy New Year to you and to the audience, and I wish you a great start to 2025. I would like to wish the same for China's economy and the stock market. And indeed, more recently, we've seen some positive news from China, with both the soft and hard data pointing to a rebound of the economy in the fourth quarter. And the Chinese leaders also become increasingly confident that the growth target of around 5% will be achieved for 2024. So when we turn our attention to 2025, uncertainties abound. And I would say it is, I think, very important for China to tap the policy space more ambitious, more aggressively and effectively to deal with the external headwinds. I would like to summarize what I've seen as the main theme for 2025 as TSMC. This does not stand for the Taiwan chip company, but instead T stands for tariff, S for stimulus, M for home or housing sector, and C for consumption. So on tariff, it's almost inevitable that Trump will impose high tariff on China and some other trading partners. We still don't know when, by how much. Our estimate, based on a doubling of the tariff rate on China by the end of the year, would reduce net export contribution to China's GDP by about 1 percentage point. And the government will have to find ways to offset that impact. I think it takes quite sizable stimulus, a stabilization of the housing market, and improvement of the consumer sentiment to offset the impact. And all those themes has been touched upon in the Central Economic Work Conference last December. And considering all those factors, we think China's economy will still decelerate in 2025. We forecast 4.5%. It is still a decent growth rate.
Shuang, you highlight some of the uncertainties that Bell was alluding to as well, whether it's related to the amount of tariffs eventually, but drilling down perhaps domestically into the local government level, when we look at how authorities are urging them to deliver cash handouts, can you talk to us about the potential disconnect here between what governments can do and what they're being asked to do, because they are after all still reeling from a debt crisis because of the property crash?
I would say I think the property sector still remain the main drag, and it also affect the local government ability to support the economy because of the falling land sale revenues. And exactly because of that, we've seen willingness at the central level to leverage on its balance sheet to support the economy. So I think there has been a lot of expectation about the growth target for 2025. We think it will be around 5%, and more particularly on the fiscal policy, the official budget deficit, we think it would be raised to 3.5 to 4% of GDP this year, higher than last year. And in particular, it is important to point out that China's fiscal position is much broader than the official deficit. Official deficit is a small part of the big picture. And we also need to look at the issuance of the local and central special bond that is used to finance the spending at the local level, to finance the recapitalization of major banks, and more importantly this year, the local debt swap program. And we think the broad deficit of the government could reach over 8% of GDP. And on top of that, there will be 2.8 trillion of resources to be devoted for the local debt swap program. That, on the one hand, would save the local government the interest payment cost, but also to the extent some of those bond proceeds will be used to clear the arrears to the private sector. The economy will benefit. For example, the private sector, when they get the payment, they can pay their the wages, the suppliers. So the benefit will trickle down to the real economy. So fiscal policy would be a major part of the stimulus. We think if the fiscal policy is fully implemented, it could provide the positive fiscal impulse could support growth by 0.3 to 0.5 percentage points.
Just briefly, what are you thinking about also the currency and where we head for the next few months? Because we've just seen the yuan fix coming out, China offering the most forceful support for the yuan since July. It was 1,323 pips stronger. But how are you expecting China to use this as a lever in the face of those external threats?
In response to the, I think, higher external uncertainty, especially high tariff, there has been talks in the market that China will use devaluation as a response. But we think most likely China will not use large devaluation to deal with the high tariff, but rather make use of the policy space to boost the domestic demand instead. The reason behind it is, first, if we look at fundamental, China still run a very high current trade surplus and a current account surplus. The current account surplus could reach 1.9% of GDP in 2024. So it does not make sense to devalue the currency significantly when it runs very high current account surplus. And also, experience suggests that large devaluation will cause large panic capital outflows. And it may also lead to a stock market sell-off. And if we look at, especially from last year, the authorities seems to attach greater importance to currency stability. And this is also mentioned in the Central Economic Work Conference. And the central bank appears to be more skillful in dealing with the currency pressure. So I think the recent pattern suggests the central bank would like to keep the fixing under the US dollar CNY under 7.2 and the spot under 7.35. And we think that is likely to remain the case before the Trump administration impose hefty tariff on China.
Yeah, certainly waiting for that clarity. That's Shuang, the Chief Greater China and North Asia economist at Standard Chartered Bank. Thanks so much for those insights. We're just a few minutes away from the open of trade, and this is how futures are looking in pre-market. More ahead. This is Bloomberg.
Welcome back to the China Show. Taking a look at how Hong Kong stocks are faring in the early goings. Looks like they're starting 2025 on the back foot. 6/10 down on the Hang Seng. Tech a bit of a drag as well. And this is following on from the pretty negative handover from Wall Street. And of course, we're going to be keeping a close watch on those China PMIs on the manufacturing front later today. Actually, later this hour, Belle.
Yeah, but on the flip side, I mean, you've got some sort of positive signals. You've got analysts, for instance, that are seeing some pretty significant upside for these stocks. And also you've got those signals perhaps of at least stabilization, because we had the December home sales figures coming out for China. And OK, yeah, we didn't see huge improvement, but we certainly saw signs of stabilization. And so perhaps there's a bit of a fragile recovery underway in the sector. Off the back, you are seeing some of these China property stocks moving a little bit higher in pre-market, but the open is just ahead.
You're watching the China Show, and we're counting down to the open of markets. Of course, a couple of economic indicators that we'll be getting in terms of the Chinese manufacturing PMIs, but really on the watch out for any forms of support. And certainly it looks like on the first trading day of the year that on the Hang Seng, we're seeing that bit of negative sentiment trickling through, Belle.
Yeah, it certainly does seem to be tracking what's happening in broader Asian equities this morning. We are mostly online for some markets, although still a number of notable closures. Japan, of course, is shut until Monday. But in the setup today, we actually are seeing a bit of divergence between A and H shares, because onshore futures are still looking like you're going to see a bit of positivity coming through. But let's take a look at the open here, because the CSI 300 just starting the day here, fairly flat so far. First trading session for 2025. Really, of course, a lot of unknowns, not just for traders in China, but they certainly are going to be grappling with how to deal with President Trump, and also those continuing internal economic issues, notably property sector, also consumption, and those plans to revive that in a forcible manner that was announced at the end of last year. That's the bigger picture there for China today. Let's also take a look at what's happening in Hong Kong, with the session just getting underway this morning as well. We are watching in Hong Kong futures, rather markets here, again, a little bit under pressure, but as you were noting, Avril, I mean, we did see a weaker end to Wall Street as well for 2024, despite what has been really a stellar run, and that US exceptionalism story very much still intact. So that's Hong Kong markets there. Let's drill down into some of the movers now, because consumer stocks as well to note, again, closing off the year, we had a Bloomberg scoop on China raising salaries for government workers. So we're hearing that a significant pay rise has been given to civil servants across the nation. Basic salaries may be increased by at least 500 yuan a month. That's around 67 or 68 US dollars. Medea, one of the ones there that's at least gaining off the back of that, up 1.4%. That is still according to sources. We'll await official confirmation on that. But in the meantime as well, tracking what's happening in the casino sector, given we had President Xi made that notable trip to the special administrative region just a couple of weeks back, it does seem like it had perhaps an unintended consequence. The high level of security around Xi's visit meant that there was actually less gambling taking place, and we saw Macau gaming revenue falling 2% on the month. So missing estimates, that is having a bearing there. You can see some of these casino stocks under pressure. And also to note, kicking off the year with some M&A activity, and we do have this story out that essentially Alibaba is selling Sunart to buyout firm DCP for $1.6 billion. That's continued a consolidation that we're seeing from Alibaba, focus on its core operations. This is offloading what is a physical commerce asset rather. So they're expecting to receive up to 12.3 billion Hong Kong dollars in gross proceeds from the sale. That is a lot less than it paid to double its stake back in 2020. But Asian investors, maybe we're going to be relatively pessimistic for the start of 2025. As we said, we've got stocks that are a little bit under pressure so far. As we said as well, all roads really lead to President-elect Donald Trump, how he plans to enact those tariff threats, the risk of a stronger dollar that comes off the back of that. At least it does look pretty firm in the near term ahead of his inauguration, ahead of tariff policy clarity. But let's get more with our senior equities reporter, Abhishek Vishnoi, joining us from Singapore. And Abhishek, Happy New Year to you. What do you think about the outlook for Asian equities over the next, say, couple of months, especially as we await that inauguration? But then we do need to see the clarity, how and exactly these policies are going to be carried out.
Happy New Year to you as well, Annabelle. And that's right, our team actually carried out a survey of buy-side as well as some strategists. And most of the respondents, about 11 or 15 respondents, said that Asia is going to underperform at least the first quarter of 2025. That's a completely different setup from what we had gotten through our survey at the start of 2024, which said that Asia would outperform. But as we all know, Asia has underperformed in 2024 as well. MXAP was just up about 7% while S&P had gained more than 20%. Now, you're right. I mean, inauguration is about to happen, and it's Donald Trump's America First policies that are looking, causing a bit of trouble for the region. Those America First policies are expected to boost the growth in the U.S. and boost inflation as well, and thereby, making the appeal of owning U.S. assets a lot higher. And at the same time, just capping the room that global central banks may have to ease. So, while Fed is on a path to ease, more rate cuts would be coming in, not as frequently as markets are expecting, and therefore other central banks in the region which are looking up to Fed may also not ease as soon as we are expecting. That's the broad setup in which Asia is operating, and Asia is expected to underperform. Now, if you go drill down further, within this underperforming, there are some green shoots, especially one on China and the other on Japan. Most of the respondents actually expect China to do relatively better than its Asian peers, not the US, but its Asian peers. That's because the setup in China of low valuations, stimulus blitz, and government looking to support consumption is supposed to bode well for its assets. On the other hand, Japan, it's a well-established fact that it has become a bellwether on improvement in corporate earnings as well as corporate governance in Asia. So these two markets are expected to do better. Apart from Donald Trump's America First policies, there are risks on the horizon with some geopolitical tensions and actually Chinese stimulus falling short of expectations. So Till March, the underperformance may continue, as our survey expects. And when in March there is another meeting of Chinese leaders, if they don't match up to market expectations, actually if they don't outperform market's expectations, then the case would strengthen that Asia might actually continue to underperform. I mean, despite all that has happened in terms of weighting changes with India gaining weight, China's still the anchor for emerging Asia. China's still the anchor for the region as a whole. So if it disappoints on stimulus, then we are looking at this underperformance extending in the second quarter as well.
So the focus will really be on Asia's largest economy. Abhishek, thank you for sharing the outlook with us. Abhishek Vishnoi, Bloomberg Equities senior reporter. For more on what traders are also looking out for the year ahead, Bloomberg M-Live strategist Mark Cranfield joins us now. So let's focus on the currency, as Abhi was talking about. It's really about stimulus disappointing, economic weakness. When you look at the yuan today, that strongest versus estimates fixed, 103.1300 plus pips, strongest versus estimates since July. What do you think is the thinking for the PBOC behind all this?
PBOC is in a tough spot here. So on the one hand, they understand that the yuan is probably going to respond negatively once Donald Trump becomes president. We do expect some new tariffs to be put onto China. They will know that, and they will be expecting that the yuan will respond negatively as it did in 2018, 2019. They would like to moderate that as much as possible. They don't want a one-sided market. That's why you're seeing such a heavy hand at the daily fixings, 1,300 pips, and they will probably keep it going for some time. We've seen before they can continue to do this exercise for a long period of time. What it means is they're keeping the onshore rate relatively steady. There's not so much they can do about the offshore rate. That's why you're seeing a widening in the spread between the onshore and offshore. That's where most speculators will take their positions against the offshore yuan. And we could see that go a long way. We've seen it go to 800, 900 pips differential. It's around 200 at the moment. There's going to be a lot more volatility in that. They're also probably keeping some powder dry as well, in case the potential tariffs are even worse than their expectations, and then the pressure comes really hard. And they will need some wiggle room. They will allow the yuan to move to some extent, even the onshore rate. They can't hold it back forever. But they don't want to do too much ahead of the inauguration in case there's some positive surprises maybe, and then they can ease back. It's a very difficult situation, especially when they're easing policy at the same time. They want to lower interest rates further, which again doesn't help the currency either. Tough times, but they're experienced. The PBOC have done this before. They're very good at managing day-to-day fluctuations. We would expect to see more stealth intervention from time to time when the market is not expecting it, for them to come in quietly and give support to the yuan.
At the heart of it, I think, is that lack of clarity as well, what we're going to get in terms of tariffs, China's NPC, maybe the Fed policy also following suit in accordance. But when you look at dollar China and how we already saw it, hovering near those multi-year highs, what do you think is perhaps the line in the sand, the kind of levels we should be watching out for?
Around about the 735, 736 level, particularly for the onshore rate, that seems to be almost a hard line as far as the central bank is concerned. Certainly 7.4, I think the alarm bells will be absolutely ringing if we see something like that. They probably in their own mind, they have numbers that they will be thinking about further down the track. They will probably be saying, well, we could go as far as 7.5 if necessary. They certainly won't want to go anywhere near the Hong Kong dollar rate, which is 785, anything like that. All of these things will start to come into play if we see a continuation of these Trump themes, which are higher yields in the United States, steeper yield curve, the Federal Reserve likely to take a pause, and it may pause for quite a long period. All of these things help the US dollar. The PBOC can't do anything about that. They can only control their side of the equation. And they are in a position where they're having to accept some currency weakness because they'd rather see the stock market go up. That's the biggest factor. And you can tell from what they were saying towards the end of last year, the Chinese authorities, they're very focused on trying to re-establish the stock market on a good footing and boost the economy. You can't have everything. No central bank could control all the levers. In the end, the currency will probably have to be the safety valve and allow a bit more weakness there.
Right, something's got to give. When we look at the global picture, it almost feels like 2025 is going to be all about Trump, maybe overshadowing growth, inflation, those kind of economic indicators. When you look at Trump trades, what are the ones that you think have legs, have room to run?
Initially, I think people are going to continue with enjoying US equities. They've been outperforming. People expect them to continue. There's likely to be some more tax cuts in the US that will boost corporate earnings. Individuals have more money to spend. That theme probably will run for a while. The idea it could all be a bit inflationary will steepen the US yield curve. People probably won't go against that initially, and it all feeds back into a positive US dollar. The problem is likely to come some point during the year. Investors will probably say, hey, we're paying a big premium for this. The US markets in general are paying too much of a premium for us to be there. At some stage, the rest of the world will look very cheap compared to the United States. And then people might say, we don't need this anymore. We can take some profits in America and we can start to switch our money. The timing of that is not going to be easy, but people will be looking for the point where US exceptionalism has just gone too far. It's become a one-way trade, and the rest of the world will start pushing back against it. We're very much thinking about what Trump will do. But don't forget, the Europeans, the Asians, they will have their say as well. Just because they may get hit with tariffs doesn't mean to say there won't be retaliation. And that really isn't priced into markets yet. We do need to watch out for what does that mean and how will it affect markets as we go ahead.
Mark, let's talk about Korea, because we've just had South Korea cutting its 2025 GDP growth forecast to 1.8%. It was earlier at 2.2%. They've also lowered their CPI forecast to 1.8% versus 2.1% that was seen earlier. So you're below that 2% target now. The Korean central bank is really in a bit of a quandary here, because yes, you've got that weaker outlook, but at the same time you've seen the Korean won under so much pressure, not least from the political turmoil, and that could also constrain it in the near term at least. So how exactly do they grapple with this, do you think?
They're in between a rock and a hard place, and just a bit like China. In the end, they'll probably have to let the currency take some of the brunt of this. They also, well, you didn't mention there was the PMI data. It was horrible. It dropped to 49 from way above 50. That's a disastrous number for the Korean central bank to look at as well. In the end, they are probably going to have to put the economy first. They will need to keep on lowering interest rates for the sake of the Korean economy, particularly considering they've got all these political problems which will be making people at home in Korea wanting to spend less. They'll be defensive. Korean consumers will probably be drawing back until they see the political situation get clearer. That's not going to help the economic outlook, which is already not that great as it is. You put all those things together, they would probably, like China, prefer to see stability in their equity market, and in the end, they'll have to let the currency weaken a little bit further, particularly if the US dollar is strong anyway. So more rate cuts are likely, but they will choose their language very carefully, and they'll be watching the inflation numbers. But right now, they are in a very difficult spot, possibly even worse than the PBOC.
Yeah, and as we're speaking, we're seeing dollar Korea won moving lower towards 14.67, that handle. Mark, it's shaping up to be quite a year. Really great to get you into the studio and to kind of talk us through all we have to watch out for 2025. MLive strategist Mark Cranfield of Bloomberg for us this morning. Now, for more on what Wall Street expects in 2025, read all about it on today's Big Take. Subscribers can find it on their terminal or on Bloomberg.com. Plenty more ahead. This is Bloomberg.
You're watching The China Show. We've just had a bit of data dropping. This is the private PMI reading for China for December. The Caixin numbers coming in at 50.5. That's pretty far short of the estimate that survey had seen it at 51.7. It follows, of course, the PMI readings that we had earlier this week that again saw a slight deterioration in manufacturing sentiment in the official gauge. We did see that pick up in the services side, but still not a great number there that's going to really give any sort of positivity to markets, because we're actually seeing stocks under a fair bit of pressure so far today in the session, particularly notable in what's happening in Hong Kong today. You are seeing a bit of a drop led by Xinyi Solar, actually, which is one of the big solar makers in China there. But that is the private PMI reading, 50.5.
Yeah, and we're also, Belle, keeping a close watch on the stock of BYD after the Chinese EV giant hit a new monthly sales record in December, spurred on by subsidies and extra incentives to buyers, though that doesn't quite look like it's helping the stock movement, still 2.6% down. For more, let's bring in Bloomberg Asia transport reporter Linda Liu in Hong Kong. So, Linda, what does BYD's record sales actually signal for the Chinese EV market in the coming year?
Yeah, so their record December sales really vaulted their annual performance to be over 4.2 million cars. Now, that means that BYD's dominant position of the Chinese electric vehicle market has just gotten stronger. And that's encroaching into the space for other players, especially the smaller companies. We've seen one called Jidu Auto that is the latest victim, really, to this fierce competition in the Chinese auto market. The joint venture between Baidu and Geely said they're experiencing financial difficulties, and that coming at the end of 2024 just signals that 2025 we're probably going to continue to see a wave of consolidation and possibly smaller players kind of leaving the game in the Chinese electric vehicle market.
And so where does that leave Tesla then? Because we're also expecting its sales figures out this week. And I mean, we could see them at a record, but still analysts seem pretty skeptical about the outlook for sales this year.
Yeah, you're right. Even though Tesla could be on track to record fourth quarter deliveries, analysts are not so confident whether they can achieve their guidance of a slight growth for 2024, which is about 1.8 million electric vehicles. But Tesla isn't really the only one that's kind of facing this weak global demand for EVs. You've seen other legacy automakers who have been kind of challenged in shipping their EVs. You've got Volkswagen, BMW, Mercedes. They've all kind of scaled back their ambitions for EV sales in the near future. This is coming after major European countries like Germany and France also kind of downscaling their EV subsidies. So the demand has been weak in that regard.
That was our Asia transport reporter Linda Liu in Hong Kong there. And now let's shift to Nippon Steel, because there's been a last-ditch effort from the company. They've offered to give the US government a veto over any reduction in US Steel's production capacity. Still trying to get this win of approval for its takeover. Shares of US Steel, you can see that big surge after the report, although President Biden is still expected to block the deal. So let's get more with our Bloomberg commodities reporter Martin Ritchie joining us this morning. So it seems like there was sort of some, at least short-term optimism from investors. But as we said there, I mean, this still doesn't exactly get it across the line.
Yeah, that's right. Biden has never flatly outright said that he will block this deal, but all the hints have been that it's heading in that direction. This, as you say, is a last-minute bid by Nippon Steel to try and get this takeover of America's venerable steelmaker, US Steel, over the line. What they've did this time, they've sent a letter to the US administration, according to the Washington Post, saying that across nearly all of US Steel's assets in the US, they will promise not to cut any capacity for 10 years. They also said they will make sure they will fully engage with any trade measures that the US government wants to take in future, and that they will agree to have a representative on their board who is approved by the US Committee on Foreign Investment. So they're trying to get this over the line. It seems a bit of a last-ditch effort. The Washington Post reporting, that there are some advisors within the US administration, advisors to Biden, who are perhaps more in favor of the deal, and perhaps they're trying to put pressure on them to put pressure on their boss.
Indeed, something we were going to be watching out for, especially if this has any clarity whether it will be resolved before Trump actually takes office. Our commodities reporter Martin Ritchie in Shanghai for us there. Plenty more ahead. This is Bloomberg. Here are some of the major corporate stories we're following. Alibaba is selling its shares in Sun Art to private equity firm DCP Capital. The Chinese e-commerce giant could receive up to $1.6 billion from the sale, which is less than the $3.6 billion it paid in 2020. The sale accelerates Alibaba's retreat from physical retail as it focuses investment on areas it considers more promising, such as cloud and online marketplaces. Looking at shares in biopharmaceutical firm China, which has agreed to sell stakes in a health unit for about $608 million. The company, backed by billionaire Li Ka-shing, expects to gain about $477 million from the deal. It says that will be invested into developing its core businesses, including targeted therapies for treating cancer and immunological diseases.
All right, another look at markets, how we're tracking so far, and really passing through these national addresses or New Year addresses we've been hearing from different world leaders. One of those is the leader for Taiwan, that's President Lai Ching-te, who used part of his address to say that the island nation, or island rather, hopes to have healthy and orderly exchanges with China on the basis of equal footing and with dignity. But possibly we're going to see some sort of tourism being opened up between China and Taiwan. So you're seeing the stocks rising off the back. Broadly, we do have markets under pressure so far, tracking what's happening with the CSI 300. We do see under pressure in the session after we had that private reading for PMI disappointing as well. Welcome back to the China Show. Taking a look at a live shot of Hong Kong there. Air quality actually isn't that great right now for the city, but we're hearing perhaps it could be linked to the fireworks. Maybe it's also about some factories just across the border in mainland China, front-loading some of those orders ahead of Lunar New Year that's happening at the end of January. But here's a look at the Hang Seng 30 minutes into the session so far, and it's fairly significantly under pressure, and some of those losses are really being exacerbated, it seems, Avril, by the PMI reading that we just had out, that private survey undershooting economist expectations.
Certainly, and I think that's showing up in what we're seeing in China bonds, but I wanted to highlight what we're seeing in the Korean won first and foremost, because we did see today Korea downgrading its outlook for this year for growth as well as inflation. The BOK Governor Lee Chang-yong also saying further rate cuts could become a source of anxiety, and this is already after back-to-back cuts in the last quarter of 2024. And of course, this is all coming against the backdrop of that martial law fiasco at the start of December. So keeping a close watch on dollar Korea won. The won is strengthening today. And as I say, on Chinese bonds, we're really seeing them moving higher. The yields earlier today hit a fresh record low as far as the 10-year is concerned. Perhaps some optimism surrounding easing, given how these Caixin manufacturing PMIs really undershot, missed the mark, and is showing you an economy that's really in need of support, whether it's fiscal or monetary stimulus. Taking a look at what we're seeing in the rest of Asia as well. Of course, this is a day of thin liquidity. Japan is still shut until Monday. We're seeing those Nikkei futures pointing to slight upside, but apart from that, really flat declines, if anything, on Asia stocks after the weak Wall Street handover bell.
Yeah, that's right. Certainly entered 2024 with a little bit of a whimper, US equities. But let's move to one of our top stories, because the FBI says it's investigating a terrorist attack and hunting possible accomplices after a truck was deliberately driven into a crowd in New Orleans, killing at least 15 people. President Biden says police are looking into any possible link between that attack and the explosion of a Tesla Cybertruck in Las Vegas.
We're tracking the explosion of a Cybertruck outside the Trump Hotel in Las Vegas. Law enforcement and the intelligence community are investigating this as well, including whether there's any possible connection with the attack in New Orleans. Thus far, there's nothing to report on that score at this time.
For more, let's bring in our US managing editor, Miles Miller. And Miles, just a couple of weeks out before President-elect Trump is inaugurated, it certainly puts that question of domestic security issues back into the spotlight.
Yeah, that's right. Of course, the incoming U.S. president, former President Donald Trump, has made domestic security a major issue. Everything from immigration to tightening issues as it relates to domestic terrorism has been something he's been supremely focused on, and he's already made his picks for Homeland Security Secretary and the like. As it relates to this incident, Americans rang in the new year with two violent attacks, one in New Orleans, as you see right there, another one in Las Vegas, and they really have sent shockwaves across the United States. Shortly after midnight, actually a couple hours after midnight, a pickup truck tearing through a crowd celebrating the new year in the French Quarter. We know that 15 people were killed. We know dozens more, about 35 people were injured, and authorities identified the driver as 42-year-old Army veteran Shamsuddin Jabbar. We're told that on that pickup truck he plowed into those people, there was an ISIS flag, and he had multiple improvised explosive devices in his vehicle, which raised fear of a broader terror plot. Now, the FBI believes that he may have had accomplices and is urging anyone with information to come forward. But again, this puts a major spotlight on domestic security in the United States. In the weeks leading up to what happened earlier this morning, we saw a memo from our Department of Homeland Security that really was trying to call attention to police departments across the country about the possibility of ramming attacks. We obviously saw this happen in a number of incidents around the country, most recently one happening in Germany, and we saw it happen here. But the FBI and Department of Homeland Security were warning local governments to be on the lookout for folks who may be inspired to commit acts in the name of ISIS or any other terror group. And in this instance, the FBI believes that's just what happened here.
A heightened state and scrutiny, I guess, on domestic security, as you say, Miles. But are we learning anything further about whether there's potentially any link between the incident in Vegas and in New Orleans?
So far, there's no link between the two incidents, besides the fact that in both of these incidents, these were cars that were rented on the app Turo, which is an app in the United States that allows people to rent cars from private car owners. If I have a car and I want to put it on, if I'm not using it much, I can put it on the app and people can rent it from me. Both of these incidents, both of these cars were rented in that manner. What we know in Las Vegas is that Cybertruck exploded outside President-elect Donald Trump's hotel. It killed the driver, injured 7 bystanders, and while Elon Musk said the blast had to have been caused by a bomb or powerful fireworks placed in the truck's bed, we do not know yet at this moment if these two events were linked, but we do know that both are being investigated as acts of terrorism. And again, it really puts a spotlight on the threat assessment for the United States that we have seen in the past few years, incidents just like this, whether it be a Christmas attack at a Christmas parade in Illinois, or whether it being, a police officer being stabbed in Times Square just 2 years ago by a lone wolf terror actor on his own. This has been something that has been in our threat stream in the United States for many years, and it's something that U.S. security officials are always very mindful of, especially during the holiday season.
Miles, we really appreciate you getting us up to speed on these incidents in the U.S. Miles Miller, our U.S. managing editor for Bloomberg TV. You can get more on that story and a roundup of the others you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers go to DayBgo on their terminals. It's also available on mobile in the Bloomberg Anywhere app, and you can customize your settings so you only get news on the industries and assets you care about. This is Bloomberg.
Seen consumer sentiment starting to drag. This expression, tang ping, of just laying flat, and the consumer just laying flat amidst a lot of the changes that China has witnessed since 2021 onwards. That's where I'm a little bit concerned as to the durability of the Chinese consumer amidst some of these, a weakening external outlook as well.
We're likely to see China be influenced by much more stimulus, the kind of stimulus that we previously saw in the West, while the US comes back. And I think that that's likely to pivot the market and interest in stock markets towards China.
Given the fact that there is a lot of uncertainty with respect to tariffs and trade with the new administration coming in the United States, the next 12 to 18 months in China for investors based in the U.S. could be a bumpy ride. But for investors who have 3 and 5 year and longer time horizons, then you have valuation on their side.
Well, there were some of our guests discussing the outlook for Chinese markets and the economy. Of course, we had the private PMI survey coming out just in the last 15 minutes or so, 20 minutes or so, but it really did show a bit of a deterioration in terms of what economists had been expecting versus what came out, because the reading there, 50.5 rather, the estimate had been for 51.7. But importantly, that market reaction, I mean, it's very clear. You've just seen the CSI 300 on the back foot to start the year. But let's get more on these details now, bring in our China correspondent, Min Min Lo. And Min Min, what are the takeaways here? Because it doesn't look that great.
Yeah, you already see the market reaction to that. It's not just the CSI 300, the 10-year yield falling to fresh record low after that PMI data come out as well. And again, as you said, a sizable miss there, coming at 50.5 versus estimates of 51.7. And this tracks the miss that we saw in the official data that came out on Tuesday as well. The official PMI, manufacturing PMI, coming in at 50.1. Pretty soft numbers for December. Perhaps a signal of some uncertainties among purchasing managers really weighing their decisions as we await more clarity around Trump's policies, especially given that we are getting close to his inauguration date, and by the time shipments get to the U.S., policies may have already changed. And if you look at the services PMI from Caixin, that is expected to come out on Monday. The expectation there, forecast, is 51.4, slightly softer than the previous month, but we did get a big beat on the official services PMI that was largely driven by a rebound in construction PMI, and we got those home sales data for December that came out today, showing not for the first time, but a good sign of stabilization. It came in unchanged from the previous year, 0%. But take a look at what we saw over the past year. It's been in the red every single month except in October and in December, which was unchanged, 0%, but still a good sign of perhaps a fragile recovery that is taking place in the property market.
So how do these sort of more leading indicators then set us up to hit what comes sort of last in terms of economic releases, the GDP figures?
Yeah, so we will get the exact numbers in mid-January, but President Xi has already foreshadowed that China is expected to hit that 5% target. He said that at a New Year's event, and his speech was publicized on Xinhua. And at a New Year's Eve speech that was televised across the country as well, he injected confidence in China's economy, talked about some of the highlights, some of the breakthroughs China has made on a number of important critical fronts, such as in science and tech, space missions, AI, quantum computing. These are all areas where China is locked in a space and a tech race with the U.S. And geopolitics taking center stage as well. He emphasized the importance of that one country, two systems model for Hong Kong and Macau. And importantly, he talked about the inevitable reunification with Taiwan and the motherland. This comes as President Lai Ching-te also gave his version of a New Year's Eve speech to the Taiwanese people, vowing to increase defense spending and to display Taiwan's resolve to fight. And again, it comes against the backdrop of Trump repeatedly saying that the U.S. would want Taiwan to pay for U.S. protection. So a lot of uncertainties on the geopolitical front going forward as well.
Yeah, so it's sort of about how China deals with those external uncertainties by also dealing with the internal ones. And we know that China's announced that they want to forcibly boost consumption this coming year. Now they've raised salaries as well.
Yeah, we're hearing this from sources. Civil servants are getting at least 500 yuan increase in their monthly salary that was paid out in December, backdated to July. This is equivalent to close to $70, but it was not officially announced by the government, so we don't know the scope of this program. The last time China officially raised civil servant salaries was in 2015, where I believe about 40 million people got a 300 yuan increase on average. And we did see, well, from social media at least, it looks like there had been salary raises in 2018 and 2021, but this were not officially confirmed. And I guess we could take this as a sign of the government really fulfilling its promise to try to drive domestic consumption. We know in December, the Politburo had vowed to increase incentives for officials to drive an economic recovery. The central government also urging local governments to give more cash handouts to those who need it. But some people are telling us, given the multiple rounds of pay cuts and slash bonuses, the amount that they're receiving doesn't actually equate to a pay rise, although, of course, something is still better than nothing.
That was our China correspondent, Min Min Lo there. And let's bring in Andrew Freris now. He's CEO at Ecognosis Advisory. Andrew, Happy New Year to you, and thanks very much for joining us so early in your morning. But we just heard from Min Min there talking about not only the outlook for China's economy, some of the data earlier, but also this possible boost to government sector salaries. How concerned and how much concern do you think we've seen from authorities so far about dealing with some of the domestic and external challenges?
Annabelle, I'll start very, very quickly. The PMI indexes, they don't show anything about industrial output. I mean, this is repeated, and it is actually false. It is actually an experiment. It is an expectational index, a diffusion index, and it consists of people, half the people saying how good, the other half how bad it is. You take the two differences, and if it is above 50, it's getting better, below 50, it's getting expectations. Okay, so I'm afraid I look at them with curiosity and mild concern. Actually, I'm not really concerned with them at all. I much prefer to look at what's happening in the overall deflation period in China, what's happening to expenditures on the retail side, which is very low, and let's say, the trajectory of what the government has said it is going to do, which is a great deal of money, but it depends very much on a drip-down effect. In other words, it doesn't put money on the table, show me the money, as it used to be in the old film. And expecting that more expenditures on infrastructure will peter through. They will, but it's going to take time. And they are very keen to see that the GDP hits the 5% now, not in a year's time. So that leaves me concerned. And the fact that the three major price indexes, the CPI, the WPI, and the index of the 70 of the prices of newly built accommodation in 70 big cities, which I won't look at it like a hawk. All of them are near to zero or negative. And actually, the 70 indexes for the newly built property in 70 indexes. Sorry, the indexes for the newly built properties in 7 individual cities, it's actually shrinking for nearly 4 years now. I mean, that is serious. That is quite important. And it is indicative. It's not a cause, it is the symptom.
We did get the residential property sales figures out for December, though, and they were flat, at least, compared to the previous year. And, I mean, some economists would say that's a signal, at least, of market stabilisation. Do you see any signs of recovery, then, in the property sector?
No, I'm old-fashioned. I keep going back, show me the money. I want to see the prices stop falling. The fact that more properties are being sold, they're being sold at a loss to whoever holds them. So, of course, it is good. I don't want to be a party pooper. I don't want to take the punch ball away straight away because it doesn't match my deflationary concerns. But it has to be very solid. And it is important to see that they are taking some action in terms of putting money into people's pockets now, not in the future. Not via more economic activity leading to more hiring, leading to increases in salaries, and so on. And of course, given the very importance of the state sector of China in the economy, it's a very crude expression to say it's sort of 50-50. Yeah, but they do have a huge leverage if they push some of the deficit straight into higher incomes. That will make an enormous amount of difference. Because people will not be concerned about the prices of their homes coming down. That has been there for years now. Years. Has been down now for nearly 2 to 2.5 years.
Addressing the deflationary issues in the Chinese economy, though, also requires shifting people's perceptions about prices and where they go from here. And that's a real challenge to change people's mindsets. What exactly can China do about that?
It's very easy giving advice sitting in my armchair and not being in China and not having the responsibility that the Communist Party is carrying. But it is indicative that they are shifting away from being relatively timid in what they are doing. And I like to hear the increases in salaries. I like to hear injections of actual money coming down, not the banks giving more money to the local authorities or to other banks for which to lend money to the property sector, which is a contradiction in terms. Okay, so this aspect of expectations is something that, let's say, cheers me up, that we're moving away to a proactive government, which is already a proactive government, but a proactive government, to my humble opinion, towards in the right direction. In other words, putting money directly into people's pockets, as Singapore did, and as of course Hong Kong, which is China, which is part of China. You know, in the last 3 years during the COVID, the government opened up its coffers and actually gave everybody quite a fat check. I was absolutely delighted to receive it, and that makes some direct difference. But the Chinese are not keen going that way. And they've got good and economic reasons, but they do.
President Xi's made it pretty clear that he doesn't want to resort to what he would deem to be welfarism. But let's talk about the market trading, though, for 2025, because a lot of the bad news around China seems to have been priced in. And actually, if you were to take a look at the implied upside for equity benchmarks, China really stands out, not just the CSI 300, but also the Hang Seng. Seems like some analysts at least see possible gains of up to 25%. Do you see any sort of upside for China in 2025?
Yes, but I expect it to be on expectational or sudden expectational moves. In other words, if I'm sitting now here in January and I will say, what can I look forward to? Well, I can look forward to Donald Trump putting the famous 66% tariff on China. Okay, so this is hardly good news. But incidentally, I think the impact of the tariffs on the economy of China have been wildly exaggerated. But that's a different topic altogether. Okay, and please don't start me on that. But expectational aspects are going to be important in actually saying, well, perhaps we can try again, dip into the market and push it up. And actually, Bloomberg itself has pointed out that the overall performance of the market towards the end of the year was not as bad as it has been thought to be, not simply in terms of numbers, but also simply in terms of the valuing of the market and also the absolute increases towards the end. In other words, they have been overall favorable, let's say, compared to those of India, which is the obvious next important big, let's say, developing country to look at. So what I'm looking for is a sudden jolt or one other sudden announcement with the emphasis on money in the pockets. That will really cheer me up.
All right, we'll have to get more details on that ahead because, yeah, we've seen these stimulus announcements so far and they've sort of landed flat. So curious for more details on that. But Andrew Freris from Ecognosis Advisory is staying with us. We'll have plenty more ahead. This is Bloomberg. Welcome back to the China Show and some of the big corporate stories that we're tracking this morning. Chinese EV giant BYD hit a new monthly sales record in December, spurred on by subsidies and offers of extra incentives to buyers. The company says it sold over 500,000 vehicles last month, pushing total sales to 4.25 million passenger cars in 2024 and narrowing its gap with Tesla. Meanwhile, Elon Musk's car company is due to report production and delivery figures later Thursday. Analysts think Tesla may post its first annual sales decline in over a decade, despite optimism around Musk's relationship with President-elect Donald Trump. Alibaba is selling its shares in Sunart to private equity firm DCP Capital. The Chinese e-commerce giant could receive up to $1.6 billion from the sale, which is less than the $3.6 billion it paid in 2020. The sale accelerates Alibaba's retreat from physical retail as it focuses investment on areas it considers more promising, such as cloud and online marketplace. Taking a look at how markets are faring this morning, and some of the biggest moves we're seeing so far is in the currency space today. You're seeing Indonesia's rupiah actually leading the moves against the greenback this morning, weaker by 0.8%, but we have had some reporting out around their deficit, and also they're seeing some uncertainty. This is relating to the Bank of Thailand now around US government policies. So that could be a bit of a drag here, but the Indonesian rupiah, as we said, one to note there. Korean won, of course, in focus because we had the cut to the GDP, the CPI outlook for 2025 earlier. The Bank of Korea governor also highlighting the challenges in really stabilizing the economy in the face of what is significant political turmoil. What is as well subject to some of that political turmoil could be solar plays in China. We're actually keeping a watch on Xinyi Solar today because we've had the company saying that their expected 2024 consolidated profit could drop by 70 to 80% on year. That's primarily due to a drop in revenue and gross profit from the solar glass business. You're watching the China Show. This is the first day of trading for 2025. Taking a look at how equities are faring in ex-Japan because Tokyo market's still shut, or Japanese market's still shut until Monday, but we are seeing a bit of pressure really across most sectors today. We're continuing to see a bit of dollar strength holding there as well. It has been one of the best years for the dollar going back, I think, about a decade actually for that. Yes, the Bloomberg Dollar Spot Index, best year in nearly a decade. So that certainly has been, of course, putting pressure on Asian equities in this region too. But let's bring back Andrew Freris, CEO at Ecognosis Advisory, joining us. Andrew, thanks very much for sticking around. I want to start with really what's going to be the main theme or question for investors, and that's how to deal with President-elect Donald Trump back in the White House in just a few weeks. Do you think the stage is set now for US exceptionalism, or is the dominant theme of 2024? Do you think that stays intact for this year as well?
That stays intact, and actually it boils down now, not whether will he, won't he, but it is how much. In other words, as I said, I like to see the money on the table. So he said 60% on Chinese on a certain class of Chinese imports, plus a 20% on top of that. Okay, and then perhaps a 20% on everybody else, or a 10% on everybody else. Well, let's see if the 10, 20, and 60 are going to be that, or they are simply, as they said, negotiating issues. But Trump, I think he will be unwise, and I don't think he's far too clever to go for that, for people to say, yeah, he's bluffing. Okay, and therefore all these big numbers are not going to be there. It's going to be something very different when we come to the table. And I don't want him to do a Clint Eastwood economics. Go ahead, make my day. Okay, only to find out he really does insist and pulls the trigger. So I want to see the numbers rather than the intention.
That could take a little while to come out as well, though. I mean, we're not really expecting, well, we don't know, of course, but we're not really expecting tariffs to start to be announced at the end of this month. And as you said, I mean, they could end up being more of a bargaining chip than anything else. So how do you sort of think about trading activity between now and when we actually start to get any sort of clarity?
Very incredibly simple. First, I'm afraid, and I say that with a degree of humility, I stopped listening to the Fed, okay, because it can be incredibly misleading, not purposefully, but incredibly misleading. So I'm telling my clients, the Fed is not going to cut interest for possibly the next half of the year. I'll say that again slowly. I'll pay the price for that, but I will, half of the year. Why? Because inflation in the States not only is not going down, it is actually progressively going up. So we have to make up our mind whether we do have or we don't have an inflation target. And therefore, cutting interest rates right now, I think it is a big no-no. And it's not going to get any better, because if tariffs come early, they are going to have a once and for all, read my lips, once and for all effect during the inflation of 25. In other words, if you put a 10% tax, which is what a tax, prices, assuming they go up by 10%, and that's it. Next year, they're not going to go up again by 10% unless the tariffs are increased. So for the first half of the year, we have two things going on. We have the natural increase in inflation and the potential jump in inflation if and when Trump puts up the tariffs. Now, these are two big uncertainties, and for the Fed to go ahead and cut interest rates now, it will be a little bit unwise. So I tell my clients, pay no attention to the Fed, and therefore concentrate on what's happening to the pricing of the stock market in the States, and also who did the pricing and whether that kind of pricing is going to be maintained. Talk too much, I'm afraid.
No, well, there's a couple of different things to get into. I mean, you're saying don't pay attention to the Fed, but I did want to just ask one question on that, because you're talking about you're not seeing any cuts in the first half. And a lot of people would say, you know what, there's really nothing in the US economy right now that justifies the Fed cutting rates either. But second half, I mean, do you see any sort of rate reduction?
Yes, I do believe that, because I suspect that the capacity of the Fed to cajole and threaten may well begin to flow through. In other words, there isn't enough, let's say, great news within the American economy to continue pushing prices at the pace that then the Fed will feel much more happy to take the risk and cut interest rates. A little bit of a convoluted answer, but what I'm saying is the balance of the risks for the Fed are going to decrease as the months pass by. But, however, and that's my important part, look, the S&P did spectacularly well last year, about 30%. Who did the spectaculating, if you pardon my English? The answer is Magnificent Seven. 1/4 of the profits and 1/3 of the capitalization. 3 of which, which is Microsoft, Nvidia, and of course I always remember which was the other one.
Alphabet or Google.
Google, yeah, they're primarily chip companies. And of course, they're primarily chip companies at the back of artificial intelligence. And artificial intelligence is under pressure now because it doesn't seem to commercialize easily. And also, there are 101 smaller firms snapping at the heels of NVIDIA, including Google itself. No, this is not going to be an easy time, for the 3 of the 2 big ones, and the other 4th big one, which is Tesla, depends on Elon Musk keeping his job. But I'm a little bit cynical here because I understand Donald Trump has installed a revolving door in his cabinet, in his cabinet office. In other words, if we like Tesla because Musk is liked by Trump, that's a little bit of an unusual way of pricing the market. So there are quite a lot of uncertainties. So I'm telling my clients, buy whatever you think it is appropriate in terms of an individual share, but don't try to buy the market, because right now that is quite uncertain.
But at the same time, not many people are willing to walk away from the AI theme either. So is there a different way that you want to play it, maybe?
Yes, stick out completely and watch like a hawk if you can make money out of a particular application. I have seen now even Bitcoin getting on the game and saying, let's forget Bitcoin as being the money of the future. Let's see how the infrastructure of the Bitcoin can be developed into something else. In other words, what I'm actually saying is that if artificial intelligence will have to slightly reinvent itself, simply saying that it's going to be the cure-all and be-all in the direct future.
Let's actually talk about Bitcoin, and let me know if it's not something you look at too closely. But we have seen so much of the pricing activity really coming down to expectations we're going to see pro-crypto people put in place, and that certainly seems to be set in or getting set in stone there. But where do you see trading activity for this year as well? And do you think we see further upside as you talk about there? Maybe we start to see greater application of blockchain technology, or I still don't really see the link though, given that many people would just see tokens, digital tokens, as just a speculative asset.
First, a declaration of sincerity. I have been writing for several years really, really strongly against the idea of Bitcoin. Idea of the Bitcoin completely. I don't like something that calls itself an asset and it's backed by absolutely nothing except the expectations that somebody else is going to buy it after I bought it. Full stop. So now, what happens to the Bitcoin going forward? As long as it is clearly understood, and I think it is becoming understood, that it is not an asset, that it is purely a trading facility, then fair enough. If my clients say, I would like to buy it, I said, buy it, but don't buy it as an asset, because it ain't an asset. Now, more and more funding activities involving putting money into companies that are going to do nothing else but promote the Bitcoin or promote its trade, okay, scares me a little bit, because it is, let's say, real money chasing after unreal money. And that's a little bit frightening. But forbidding Bitcoin or going out against the Bitcoin, I always thought that was a little bit perhaps immature. And of course, Trump is the friend of Bitcoin, so is Elon Musk. So more power to their elbow, and more power to the elbow of people like me, telling anybody that could hear, okay, yeah, the Bitcoin is 100,000. And what does that mean? Can you please explain to me why it is 100,000 and not 90 or 110? And the answer is nobody can possibly explain it, because there are no assets behind it. It's as simple as that.
All right. Well, Andrew, I hope you can stay with us, because we've actually still got a couple of questions for you. That's Andrew Freris, CEO at Ecognosis Advisory. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can also join the conversation by sending instant messages to our team and to our guests during our live programming. Check it out at TV Go. We'll have more ahead. This is Bloomberg. All right. You're watching the China show, taking a look at natural gas futures. They're under a little bit of pressure so far. You are seeing, though, a bit of a spike in the European gas contract instead, and that's as Russian gas has stopped flowing to Europe via Ukraine, closing off a route that's operated for 5 decades. The stoppage will slash Russia's revenue by about $6 billion a year and force Central European countries to source more expensive gas from elsewhere. Let's bring in our senior energy reporter, Stephen Stapczynski, joining us. And Stephen, I mean, we've already sort of seen that diversification away from Russian gas, but just talk to us about how significant this move is.
I mean, I think it has a historic implication. This line had been operating for more than 5 decades through the Cold War, through the disintegration of the USSR. There were many new fees that had to be negotiated with the newly liberated Ukraine and the Russian government in the 2000s and 2010s. So this has a more significance in terms of just what it means for Russian flows to Europe, but it doesn't really have an enormous impact in terms of energy security. It provides about 5% of gas to Europe right now. So that means that previously they had 10% dependence. Now with this offline, it's going to be 5% dependence on Russian gas. Before the war in Ukraine, it was above 40%. So it's a slight downtick. There won't be, for example, shortages of gas in Europe this winter. Most likely there is still gas in storage, and they can look to other avenues to get gas. But what this does add to is pressure on prices. This could boost the price of natural gas in Europe because they're going to have to depend more on storage. And if they depend more on storage, it's going to cost more to refill it. As well, they're going to depend more on liquefied natural gas, and that could be more expensive than the fuel that they get from Russia. So those things together could boost the price of gas and lead to potentially more demand destruction across Europe for gas-intensive industries. We saw that happen quite a bit from 2022 onward in Germany, for example. And as gas prices stay higher for longer, that does add an inflationary pressure as well.
Yeah, talk to us more about the pricing. What sort of upside are we seeing? And again, that inflationary impact, how big is that likely to be?
You know, we've already seen gas prices in Europe jump 50% last year. Now, I do want to note that while gas prices in Europe are above normal levels pre-war in Ukraine, they're still far below the record high levels that we saw immediately after Russia's invasion of Ukraine in 2022. Still, that being said, the higher gas prices, it's going to have an impact across the board. It also results in higher electricity prices for countries that are dependent on gas for power generation. It's going to result in companies fertilizer companies, chemical companies, That's going to make their feedstock more expensive. So not only does it hit industries, but it hits households because gas is used for heating as well. It's used for cooking. It's used for power generation. So you will see an uptick or at least inflationary pressure continue if this is a factor. That all being said, Europe has learned to kind of pull back demand and conserve energy in times of crisis, as we saw in 2022. So is this going to be an enormous inflationary factor? Unlikely. It's going to be one of a number of factors facing Europe as well as Asia, because Asia competes with Europe for liquefied natural gas. But it's just one more thing to kind of keep an eye on as you figure out the impact on the economy.
That was our senior energy reporter there, Stephen Sapczynski in Singapore. And let's bring back Andrew Freris, CEO of Ecognosis Advisory. And Andrew, I mean, we just heard Stephen there saying perhaps, yeah, we can't really expect such a big inflationary impact, but you've also been looking at that Russian gas stopping flowing to Europe. And what do you see as the implications of this?
Well, the implications for this is the triumph of the capacity of the European Union, which not exactly works very well together internally, is that within 4 years, as we heard, they moved from a 40% dependency to a 5% dependency. Now, that's incredibly good news to anybody that says that once supply chains are disrupted, oh, good God, God help you, what's going to happen. In the European Union, there was a huge shock after the war broke out, and we knew there was a big inflationary pressure. We had a lousy winter, and then within 4 years, they have changed completely their dependency. Great. I think it's absolutely fantastic news. Stephen pointed out that prices may very well increase, and actually my understanding is that the European Union is buying now most of its marginal addition to what is needed from the United States. And it is unlikely that Trump will do a lot of things, but he's not going to say, I'm going to switch off the taps unless you do something or another.
Let's think more broadly then about you mentioned, the diversification we've already seen. We have seen supply chains across a number of different industries being diversified as well. So do you think that also dilutes possibly the inflationary impact of tariffs?
Read my lips, 100%. Okay, I'm old enough and, let's say, experienced enough to know that there is something called competition, which takes the form of an unpleasant rabid dog that sleeps in your bed at night and you have no idea it is there, and in the morning you're bitten and you have no idea what has happened. In other words, competition and capacity to diversify and to move, of course not overnight, that's stupidity, okay, but to happen very quickly, particularly when there are financial pressures, is absolutely enormous. That's why I'm observing the chip situation, okay, very carefully, and particularly I'm observing the capacity of small firms to effectively win away and pare away the near monopoly that NVIDIA had about 9 months ago. I remember saying the graphic chips on NVIDIA are irreproducible. NVIDIA can actually ask any price it wants because it is the only one that holds the key to artificial intelligence. Watch my lips and watch my eyes. A year later, the situation has changed quite dramatically. NVIDIA still is a major producer. It has its most recent family of, I've forgotten now whether it's called Blackwell or Blackwell, something like that.
The Blackwell server system, yeah.
Exactly. But then so does Microchip very quietly, and so does Google are also in the background, yapping away. So yes, diversification, via competition is the deus ex machina. And anybody that goes to bed thinking, I'm safe, they're not.
But we still do see companies that are struggling to catch up. I mean, I think Korea really presents an interesting case here. And Samsung lost so much ground this year because there was the perception and maybe the reality that they were missing out on the AI boom. And they haven't managed to get their HBM chips, for instance, certified by NVIDIA just yet. Let's speak about Korea, because this morning as well we've seen the GDP forecast being downgraded, the CPI outlook, as well as we've heard from the Bank of Korea governor talking about the outlook for monetary policy. This is a central bank that could end up being a little bit constrained by the won weakness in the face of political turmoil. How are you reading this market over the next few months as well?
I'm reading the Korean market with a huge smile in my face. I'm afraid I appear frequently enough in Bloomberg not to commit the mistake of saying, oh God, here comes Andrew Freris and his defense sector. I'm a huge fan of defense interests across the world. And Korea is absolutely perfectly positioned to produce aeroplanes, boats, guns, tanks, electronics that back them up, and it is actively increasing its defense spending for its own defense. And of course, it will be able to sell a lot of guns. I know this sounds unbelievably moral, but we're talking about reality. So in the case of Korea, the diversification of some of its industrial output, particularly on exports that used to go to the United States, can be very easily and swiftly changed towards defense, because the major companies, the household companies that produce your television set and your Hyundais and the rest of them also produce tanks, aeroplanes, and big gunboats. So Korea is perfectly situated. It's not going to happen overnight, but it can do it. It does not need to say, look, we're producing gardening equipment. How on earth can we produce jet airplanes? No, they're already producing jet airplanes, except they're commercial as opposed to fighters. So,
Andrew,
yes,
just very quickly.
I'm observing the situation.
I want to get your views. No, well, defense tech is really interesting, and I want to get your views on that just broadly. Do you think defense tech, do you think maybe quantum technology that's also really heated up at the end of last year, do you think these become the hotter sectors than AI?
Watch me. Yes. Not only that, not only because the United States is spending more, because finally the European Union woke up to the fact that they need to have a very strong and well-equipped army, and also very quietly, and I'm becoming a kind of mini expert on that. You should see what's happening in Asia. It's absolutely amazing the amount of money which is quietly being spent, with Australia constructing what will be potentially the biggest submarine force in the Pacific, except that of the United States, quietly. Okay, but it's happening. And of course, Japan is arming to the teeth. But they do it very quietly because, of course, it is politically inauspicious to go around flexing their muscles. Yes, I'm very bullish on the defense sector. And I'm aware that there are moral, ethical issues there, but I'm aware of that.
Yeah, it's all about that shifting global order, right? Andrew Freris, thanks so much for joining us throughout this hour. That was the CEO at Ecognosis Advisory, Andrew Freris, there in London. We'll have plenty more ahead. This is Bloomberg. We've got markets on the back foot 90 minutes into their session so far this morning. We did have that PMI data, the private survey for China, adding to that risk of sentiment, undershooting economists' expectations, but still in expansionary territory. Macau casino stocks also to track this morning because we had the revenue figures coming out, and actually we saw weakness in December, a miss on estimates there as well. It turns out President Xi's visit to the Special Minister of Region might not have been all good news, because that heightened security around his visit meant that there was less gambling taking place, so fewer people at the tables. Property stocks also one to be noting today, because we had the property figures coming out, and December home sales, they actually stayed flat in December compared to the previous year, so maybe a little bit of market stabilization, and it seems like any at least neutral news seems to be good news for this sector, because you're seeing stocks here pushing higher. As we said, Hang Seng under pressure so far in the session today. Pretty much every single stock is in the red so far to start trading for 2025. We do, as I said, have that CPI figure, or PMI data rather, that is really adding to that negative sentiment for traders. But that is it for the China Show. Inside with Haslinda Ominis next. Stick with us.